Welcome to Franchise Secrets. I have Jeff Herr on. He's my business partner at Front Street Equity Partners, and we got into some fun conversations around franchise fees. What's market? Why brands charge what they charge? Why do they? What a brand should be seen as franchise fees? What prospective franchisee or a franchisee should really be looking at with franchise fees? We also talked about the biggest kind of rookie mistake Jeff ever made, and it's the stupidest thing that he's ever done in franchising, and he had to pay for it, and it's a good one. So I hope you enjoy this episode with Jeff Herr.
Representing Franchise Secrets, Erik Von Horn.
So, founders a little nervous.
Yeah,
good nervous.
man,
A little good nervous is not bad, right?
We were just talking. Yeah, so I was crushing out the treadmill this morning. One of the founders of one of our portfolio brands texted me, and the text came across, and it reminded me. There's this smartest guy I've ever met. Is a operating partner at TPG, and I'm not going to mention the name, but I couldn't get enough of this guy. I was a sponge around this guy because he just had little brilliant things to say all the time. And so when we were out there looking for brands to invest in, and we would come out of a meeting and we would compare notes, I remember one time I was like, man, that guy seemed a little paranoid. Like he talks more about his competition than his own business. He's like, yeah, I agree with you, but Jeff, you want a founder to have a little dash of paranoia, just a little sprinkle. It's good stuff. And so I'd put that in this cat. I mean, look, this founder is awesome. We love her. But yeah, I mean, a little dash of paranoia means you got your eye on the prize, and you're looking forward, but you can see what's on the periphery. So anyways, there's another brand in the space that took on an seed round investment, and she was just asking for some intel, like, what's that mean?
What does it mean? They got some money. I saw a press release.
Yeah,
they got some money. They got a seed round. Did they give up half the company or a percent? Yeah, right. Or what did they get for that money?
How much did they give up for it? What do you think it's valued at? I'm like, well, it's a 2-location operation. It's just really difficult to value. So. And I was on the treadmill, so I texted her. I'm like,
were you breaking a sweat? Were you breaking a sweat?
I was breaking a sweat, man. I mean, I don't run on the treadmill. I'm too old for that. And I'm trying to be consistent. If I run, then what's going to happen is I'm going to break down. But I'm in week 4 on a stretch here. And today I did 60 minutes at a 7% incline at 3.5. That's not bad. That's like 15 minutes of pickleball, Jeff. That's like 15 minutes of a good pickleball game. I mean, look, it's better than doing nothing.
100% it is.
So I said,
so you're on the treadmill. You get a ring from one of our founders.
I texted her and I said, look, my guess is this is a convertible note. I said, I'm on the treadmill. I'll call you afterwards. And she said, call me afterwards. I'm off to Google, meaning she wanted to Google everything before we talked. She wanted to Google everything that there is to know about a convertible note.
By the way, this is a lot of emerging brands, period. This isn't you just flip the script. Brands wonder what they're worth. And, at different times what they're worth, whether they're just starting out, 2 locations, two corporate locations, just starting to franchise, maybe have a franchise or 2. What are they worth? And then how do they grow? And how does somebody even value a brand like that? And you and I have these conversations all the time, but they're usually new to founders. So keep going.
That's great. So yeah, I gave her a ring afterwards, and I just said, hey, look, I don't know the terms, but typically when a company is so new and it's very difficult to actually value, and if they want to raise money, they're going to raise it in the form of debt versus equity. Now, you can have an instrument called a convertible note that it's debt today, but it's meant to be equity in the future at a certain point where the company is actually valued. usually that debt is going to convert to equity when the next investor, the next round comes in play and actually does stake a valuation to the company, and then it can convert. So you're saying, hey,
so it's debt originally because
yes,
nobody can really put a solid valuation on it. Nobody really knows what it's valued. It doesn't really matter. It's going to be valued at some point in the future with a true valuation. So the investor invests, but it's debt, and then it has a mechanism when there is a valuation at some point in the future, they're able to have some type of conversion into equity at that point.
that's right. I mean, look, there is a value to everything, right? It's what somebody's going to pay. So, but when you're starting out a new venture, this is a new company starting out a new venture. They have high hopes. It's blue sky. They have decks galore. They've got Excel spreadsheets that show that it's going to be $1 billion company. It's going to be a unicorn in the next 3 years, whatever. The reality is that yes, you can they do have existing operating locations. My guess is those are profitable. Otherwise they wouldn't be franchising them. There is some relative multiple on profitability of corporate units, probably somewhere around 3 times EBITDA or 1 to 1.2 times revenue. Certainly, though, if you're raising over $1 million and you do the calculations that I just showed and that equals $1 million, that doesn't make any sense. So you go to investors and you say, hey, look, this is where we are today. This is where we think we're going in the future. We'd like to raise some debt, basically venture debt. It's a convertible note. Because you're the first investors in, it's probably a friends and family type round. Because you're the first investors in, we're going to give you a discount. We're going to give you a sweetheart deal when it does convert. So, in just real short layman's terms, let's say that somebody invests $1 million in a convertible note and it converts at a $10 million cap. Basically, that means that the next person that comes in says, hey, we're going to value your company at $10 million or more. That would be the trigger point for this debt, this convertible note to convert. So if you do simple math, you might say, hey, if I invested $1 million and 2 years later the company's worth 10 million and I convert, then I should get 10%. Well, that's not really fair because the first million in that convertible note was super risky, right? It was all built on blue sky and decks and Excel spreadsheets. And so they should get a little bit more than just they were there at the beginning. Now it actually is worth that.
Attention, franchisors and franchisees. There are 2 really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisor and you're frustrated that you're not awarding as many franchises as you thought you would, this is the reason I created the Franchisor Mastermind. If you want access to the information, the techniques that the best franchise sales organizations are using to award franchises, and you want what mature brands have with their playbook of having happy, successful franchisees that grow the right way, then you might want to check out the Franchisor Mastermind. The reason why people join is they want access to my Rolodex, my connections. They want the playbook to achieve both short-term and long-term success. They want to increase enterprise value in their brand. Links will be in the show notes or at scalablefranchise.com.
So they're going to put in some kind of discount. They're going to put in some kind of multiple. So they should, for taking that risk early on, that investor probably is going to convert at a higher, well, they are going to convert at a higher rate. They are also, along the way, there's a coupon interest, right? So it depending on, you can put out whatever rate you want, but it's probably prevailing rates. So right now it's probably 12%-ish money. Could be lower, could be higher. I don't know. But that's a coupon that typically when you're doing a convertible note, you're not going to take that money. It's not like conventional financing where you start making payments on principal and interest. That coupon just gets lopped on top and carries forward, so that you're bringing on this capital so you can reinvest in the business to grow. You don't want to start having to make principal and interest payments on that. So it goes on top. When it converts, that also converts with the principal on the note.
So it's not draining the company of money, of high interest money. They're not having to pay a lot of that as they're growing.
That's right. And so she said, well, why are they taking on this money? I'm like, well, because they want to grow the business. They're probably going to make some infrastructure moves, right? Probably around human resources, maybe around technology, maybe around processes and systems. They might want to hire some external support agencies, vendors to do this or that. They also need to find great candidates. So they might be investing in PR. They might be investing in other channels to drive interest in their franchise concept. So I'm like, look, $1.4 million, if you really are getting after it and you have to substantially grow your HR stack, your tech stack, you got to put a lot of money out there to drive lead flow. Like, that money could get vaporized pretty quick. So,
and this is something good for franchisors to think about. I mean, you and I are talking to brands every day.
Yep.
We're talking to brands. We're talking to new brands, like new to us, probably 3 to 5 a week, depending on the week. And this is these are questions that they have, and how quickly do they want to grow? Some of them should remain like, let's grow friends and family for the grow three franchisees a year for the next 3 to 5 years as they figure things out. That's a safe way for a brand that doesn't have the resources and the expertise to grow and scale rapidly. But then you got somebody that wants to grow and scale rapidly, which means an exit at some point in the future. That's going to happen sooner than later. But you have to have expertise and resources, financial resources, to be able to do that. And, as we talk to these different brands, some of them are just not ready to grow that fast. They don't want to grow that fast. They want to grow, a handful of units a year as they kind of figure things out and grow up as a franchisor, right?
Yes. I mean, it takes a lot, man. Time, money, energy, people. It's expensive.
Energy. The founder has to be driven. As we look at brands, we look a lot at that founder. Remember that call we had the other day, Jeff? The one with the lady that we basically said, you should not sell franchises right now. And she's like, I want to sell franchises. I need a franchisee, and they're going to prove out the model. Basically, we're like, no, we told you that. We're giving you bad advice, but that's what she wanted. Remember that one?
Well, yeah, but you kind of skipped right to the punchline, right?
Of course, I did.
We were a lot softer before. We had tried to.
We didn't even talk about the whys. Keep going. Tell us. You're the master storyteller.
Well, we got better stories. But so yes. I mean, I think that one of the most interesting parts of our first calls is it's the old swapping of stories, But I love kind of like I love that one podcast, like how you built that or how I built this, the NPR one. I like that. I love founder stories, man, because one thing that a founder has to have, they got to have the grit and the grind. We talked about that in previous podcasts, but they absolutely have to be great storytellers. Like when somebody tells you where they came from, where they are today, where they want to go in the future, there has to be an emotional connection. I mean, if you think about all the great founders of all the great brands, they were great storytellers. You just know it. Like if you think of all the great founders that are active today that we know, like that's the common thread. They got to be great storytellers. And so we love hearing these stories. And we've both learned that we should always take a first call. Sometimes we've been super surprised and it's been very positive. And sometimes we've just said, hey, that's a head scratcher. I don't know if they should franchise. But we always take a first call, and we're not afraid of things that are super niche-y. And this was a super niche business. And they certainly, because it's so super niche-y, I don't believe they have any competition in the world of franchising. But they do have competition on a global scale, with like conglomerates, right?
Yeah.
So like that's
many billions.
Many, like many million. Yeah. Like dozens of billions, like hundreds of billions of
You
dollars.
don't want your competition to be dozens of billions.
It's like in Shark Tank when Mr. Wonderful's like, they can crush you like the cockroach that you are. It's like that's. When if you're gonna go up against like global multi-billion-dollar conglomerates, wow, that's a tall task. Anyways, I think the business is really cool.
Yep.
It's female focused. I have 3 daughters. My wife, I think they would really dig what she does. I really do. And I think that they would try it out, and I think they would like it. And I think that she's on to something. Definitely big headwinds with what we just described, but I think it was pretty cool. The challenge is at some point in the introductory call, after we talk about the story, which we thought the story was cool.
It's a great story.
She had the resume. She was a validated founder, meaning the business, the product, the service that she's offering. She's been doing this her whole life.
Yeah, she knew it inside and out. She obviously,
man.
She's educated
This wasn't
in
a little,
it. Yeah, she lived and breathed it, and is now doing it in a different way. But yes, without a doubt.
There you go.
Great personality. We really liked her.
Great personality. This wasn't a passion project. This is what she's been doing her whole life. She's just kind of turned this into a business, right? So once you get through all of those pieces, eventually you kind of have to say, how are things going financially? Like, where's it at? What you want to hear. Look, if you're going to take a brand to market, one of the boxes that just has to be checked is the unit economics. They just have to be strong.
Show me the money. Unit economics. Anytime you hear that in franchise, like, show me the money. How much money are you making, and how long have you been making that kind of money, and how much did it cost you in terms of investment to get to that point? So we dived into all of that with these brands. So we were at that point in that conversation with her, and then she started to squirm a little bit.
She started to squirm, and that's when you know that there's some trouble. Look, I think that one thing that we really pride ourselves on is I believe that our brands have world-class item 19s, financial performance representations that our brands put out there, the level of detail, the amount of pages, the amount of everything being broken down. I don't know anybody else that puts out more comprehensive data for people to analyze than the brands that we have. And that, I think that and that's something that I am very proud of. I think that you are too. Just because it's in an item.
I am.
Right? Yeah. Just because it's in an item 19 doesn't mean that that's what's going to happen in the future. But I think that the more data that can be supplied to a potential franchisee gives them more data to analyze, and hopefully that additional data helps them make an informed decision. It's not a guarantee that it's going to go the same route, but I believe, like, look, put it all out there. And some brands will say, I don't want my competitors to see that. Look, the bottom line is it's either a strength or a weakness. If you want to hide it, then you probably shouldn't be franchising it, right? But if it is good, then throw it out there. And it also, look, if you do throw it out there, then it also it tells you the blueprint of how to improve. So you put it out there now, and next year you have to improve upon all the numbers that are in there. So I think that's great. So
let's just real quick on putting it out there. Most of the time, when we talk to these founders, their reason for not having an item 19 is because the numbers are not very good. That's the reason most of the time. Sometimes it's we're killing it, we're making a ton of money, and we don't want our competition to know. We don't want to give them any insight. But most of the time, the item 19s that are either left out or very incomplete are because the numbers are not that great. Would you say that's true?
That is true, and that was the case here.
Yeah.
She just didn't want to. She didn't want to do one, and when you probe a little bit as to why, I mean, that was the reason. She's just like, the numbers aren't good enough. So, yes, I think that 10 years ago, I mean, this is just anecdotal. I'm just throwing out random percentages, but I would probably say that maybe 10 years ago, 40% of the FDDs or UFOCs, I don't know when that switch happened. You thought
Long time ago.
but long time ago. But
we know this stuff because we had Gray. We were around at that time.
yeah, I got gray. I got to start using the just for men soon. At least I got it though. I got some hair that I can use just for men.
No implants? Is that all real?
No. I'm Irish, man.
Yeah.
I got the Irish mane.
I'm all real. It's all real up here.
You're pretty legit. So yes. So in this instance, not comfortable doing it. Once again, I think like 10 years ago, 30 plus percent, 40%. I don't know what the actual number is, but that feels about right. Didn't have one. Now, pretty much everybody does. There are still brands that come out without it. There are some law firms that might recommend not having it. I mean, I'm not a lawyer, so. But what I would say is what we hear from the franchise consultant side of things is it's very difficult for when they have a candidate that they put out to a brand that doesn't have an item 19. That's one of the first things that comes back to the consultant, and they say, hey, I love this thing, but they're an emerging brand. They don't have an item 19. They can't give me any information. They don't have a lot of franchisees for me to get that information from. What should I do? And the consultant has their hands tied. There's nothing that they can do about it. So I think that it's very important. I don't think any brand should be franchising unless they have compelling unit economics. I also don't believe that unit economics is the reason to buy a franchise, right? I have literally told candidates in the past, like, don't buy because of the numbers, right? It's definitely a box you want to check, and sure, build out a pro forma and do whatever you want to do. And that should be a box you want to check. But at the end of the day, if I'm a franchisor, I want the franchisees to be ambassadors of my brand. Yes, of course I want them to be profitable. Of course I want them to have same store sales growth year over year over year. Absolutely. But how they get there is not by chasing the numbers. How they get there is by going all in on the brand, on their business, on their employees, on their customers. And then the money will follow. That's a guarantee, right? But anyways, for brands that I think you have to have compelling numbers or you shouldn't franchise your business.
So when when we were talking to her, we felt the pain. We felt her pain, and like we're empathetic. We're not like, oh, you're not making any money. See you later, click. We are like, let's help her out because she's obviously not getting good advice from people that are making money from her being a franchisor right now. Whoever can make money off of that, and we won't get into that right now, but they are making money and they are obviously giving her false hope. We said the best thing is you haven't sold a franchise yet because they're not going to, if they follow what the blueprint that you have, they are going to be losing money for a long time. And she's hopeful that the franchisee will come in and do way better than her, and that will help her start becoming a good franchisor. So we told her, just focus on your business and get the unit level economics up. In other words, start making money. And then when you figure that out, then start franchise, then, get your first franchisee. But that's what she should be focusing on versus trying to find a franchisee. So
Yes.
That was a hard one. That one, like, we gave her good advice. She didn't like it. She really didn't like it, but we kind of knew that she wouldn't like it because it's kind of hard to hear. But
it's hard.
We like to leave calls helping founders, helping them with their, with what's next for them, whether they want to hear that or not. Most of the time they do want to hear it. Most of the time they don't go like that, but we figured we'd share that one on the podcast.
Sure. And then, before we kind of change our tune here, like, then it went into, well, the reason that my location isn't performing the way, necessarily the numbers aren't that great is because it's not really representative of what like a franchisee is going to have. It's too small. It's not in the right location. There's not enough population around me to make it work. It's like, okay, well, then you got to put together the model store. You have to, I would think about opening up another location that is representing what you want this to be. It is in the right location. It is the right footprint. It does have enough traffic going by or enough population or households or whatever you want to do for your territory to make it work. And then it was, well, I don't have the money for that. So how are you going to get the money? Well, I'm going to sell franchises to get the money for that. No. That's the cart before the horse. Go out and raise some capital. I mean, she just didn't want to take no for an answer. And then we came out with your punchline. Like, it's like, you just shouldn't be doing it. Right.
Wow.
But she's not the only one that wants to go to market. I have something that I want to share because it blew me away. So we were on a call this week with our good friend Dallas, right? Chief Development Officer at a company that supplies data to the franchise industry. And we were just chin-wagging.
By the way, that company's been on the podcast twice with the founder and one of their key people.
So the topic of conversation was, how many new brands are coming to market in any given year? How many brands are coming to market on a quarterly basis? So one of the things they kind of put, they track that stuff. I mean, they're a data company, so they track that type of stuff. And here was pretty shocking. So like, we talk about these types of numbers. We hear a lot of, I always hear it on other podcast numbers. The numbers that I usually hear, we say these numbers, I think that they're validated by this data company. Other people say them on other podcasts. There's plus or minus around 4,000 different franchise concepts that are out there in America today. In any given year, there's around 400 new ones, right? So that's pretty good. Now, the other stat is that the number 4,000 doesn't really seem to be growing that much year over year, right? So there's 400 new brands that come out to market and say, I'm a new brand and I want to franchise my business. But the number hasn't really changed that much on the 4,000. The total aggregate number hasn't changed that much, which a little bit of like math would tell you that if there's 400 new ones coming in, there's like 400 also exiting, right? Doesn't mean they went out of business. They just don't want to franchise anymore. They don't want to have the offering. Maybe some of them are winding it down. There's lots of reasons why not to franchise anymore. There's probably more reasons why not to franchise than to franchise, right? So those numbers, I'm not saying anything that anybody hasn't heard before, but this was the shocker to me. Let's
not tell anybody this one. Let's not tell anybody.
Is it a secret? Is it a franchise? Is it a franchise secret?
We can tell them.
I mean, wait a minute. First of all, if it's a franchise secret, like people come to this podcast because it's called Franchise Secrets.
That's true.
They want the secret.
Yeah, we get the secrets, and we have to share some of them. We keep some of the secrets to ourselves, but we have to share some of the secrets when we talk to people that know the secrets.
That's right.
All right, that's a good point. Okay.
So once again, just using the old abacus and doing some simple math, if there's roughly 400 new brands that come to market for franchising on an annual basis, if it was equal, that's about 33 a month, right? 33 a month times 12 months is 400, right? Now, of course, it's not always the same amount every single month, but you can see the point. Dallas told us that in the month of October, there was 100 new brands that came to market in the world of franchising. Now, if you amortize that out over 12 months, you would hit 1,200. That's like a 3x above and beyond what is normal, right? Now, are another 100 going to come in November or December? Probably not. Maybe October is always a big month because people want to file before they get into the holidays. But one thing is for sure, even if October is a bigger month year over year than any other month, they have never seen more brands. This is a landslide number. They've never seen more brands come to market in one single month than October of 2023. That's right. 100, over 100 new franchise concepts. That's a shocker for me. That's a shocker for me. Think about this too, right? Like, franchising your business is even more challenging than it was a year ago. One thing is cost of capital. Everybody knows cost of capital is significantly more. Inflation, right? So most businesses, you have employees, right? Employees, there's challenges in hiring people today. In order to overcome challenges, many people have to pay employees more today, significantly more than the annual bumps that they had to do before. If there's inflation, right, most businesses have some level of cost of goods. If inflation is 10%, then that means the cost of goods is probably relative to inflation. So your cost of goods are up 10% versus the normal 2 to 3% year over year, right? So margins are getting squeezed. So that's one reason why it's maybe more difficult to franchise your business. The next is financing. Interest rates are much higher than they were a year ago. It's not crazy to finance your business today at prevailing rates up around 12-ish% on a variable rate. That was 4, 5, 6 points lower a year to 18 months ago. So there's headwinds, inflation, human resources, cost of capital, but yet we're 3xing the amount of brands that come to market in a single month. I don't know. It was an eye opener for me. Well, and so
yeah, go ahead.
So I was just going to say, and this might be something we could roll into, but it's like, okay, so if I know that, if I'm one of those 100 and I'm coming to market, like, what's my strategy? What's my strategy? Like, I'm the new guy on the block. Like, what was the purpose of why I did franchising to begin with? But what's my strategy? There's a lot more noise. There's a lot more brands to compete with. And, we talk about it all the time, Eric. Like, I think that sometimes a franchisor thinks that they're competing with other franchisors in their industry, in their category. And I was talking to the founder that I mentioned earlier today. When I was talking to her, and she had brought up this competitor that seems to be kind of head to head with her. I'm like, look, you're competing with any brand that's franchising their concept.
Yeah.
Right. If there's somebody that's interested in becoming a franchisee of your system, in theory, they could be interested in becoming a franchisee of any system.
Yes.
So it's not, you have to look beyond just your category and say, hey, look, what else is out there? So it's just more noise, and there's more challenges. So how are you gonna get traction, right? How are you gonna launch? If you're one of these 100, how are you gonna launch? How are you gonna get traction? How are you gonna turn that traction into scale if you know there's more headwinds today than before? And I think it's like, you got to surround yourself with top talent, in-house talent, vendor talent, agency talent, advisory talent. Like, you got to build a dream team. I don't know. You got to have people in the know.
One of the things that brands coming into it, and they feel the competition, they see the competition, they might even realize their competition is other brands outside of their category, outside of their industry. And one of the things that you and I hear often is, well, I've got bigger territories and lower franchise fees. And that's their selling point. And we were just, we received an email today today that said, hey, our attorney thinks we should have lower franchise fees than what you guys think we should have for franchise fees. They're getting business advice from attorneys. Lesson number one, don't get business advice from attorneys who have not built something substantial in whatever you're building, whether it's the industry or in franchising. They're there for a specific role in your business. They're there to help give you legal advice, keep you out of trouble, put the guardrails on, etc. They're not the experts at helping you understand what you can get or can't get for your franchise fees. And then a lot of times in the same conversation that they want to have lower franchise fees, they're talking about how cash strapped they are. And it goes back to your point, Jeff. If you don't understand how to sell franchisees and understand the value in your own system on why you're charging the fees that you're charging to be able to actually help franchisees be successful, then you're probably not going to be able to grow that fast. If you do grow fast, it's probably not going to have a very good outcome. So what do you think about a brand that wants to compete on lower franchise fees?
So one of the things that you said was, here's let me make a statement here. We don't tell anybody what the franchise fee should be. What we do tell them is what is market.
Yes.
Right? Like if you come to us for advice, we're going to provide you advice, right? And one of the pieces of advice we're going to provide to you is what the landscape is. What is the landscape? What is market? That once you understand what market is, then you can make relative decisions to market. Okay. So what we try to do is say, hey, look, if you have this type of fee structure in your item 5, your item 6, right? Then that's whatever it is, it's fine, right? If you want relativity to those numbers, let's take a look at what market is, right? So he is currently probably 20%, 25% below market. So what we were just saying is like, what is the purpose of that? What's the meaning behind that? And if the answer to that is, well, because that's what's going to make us more attractive, I don't know if I agree with that, right? The only time that price is going to matter is, number one, is if you're a commodity, right? Like if what you are as a product or a service is a commodity, then yes, price is going to matter. Sure. I mean, be the lowest guy. It's a race to zero. We don't want to be in commoditized businesses. Okay. And I don't think any founder would say that what they do or offer is a commodity, right? Offering commodities is probably a business that should not be franchised. So if they agree it's not a commodity, then okay. So what would be the other reason to have the lowest price? Like the only time it's going to matter if it's not a commodity is if what you are offering and what somebody else is offering is truly identical in every single way. So if every single box has been checked off and every single thing is completely identical, then yes, if something is $20,000 less, if everything else is identical, then sure. Why? If everything is the same, why would I pay more? But there's no such thing in the world of franchising.
I've never talked to a founder that says we are exactly the same as our competition.
Well, we would run for the hills because what we're always looking for is point of differentiation, right? Yes. What's your POD? Like, no, man, we have no POD. We looked at the number one player in the market and we're the same. Like you're right. You would never hear that. Okay. So if you have points of differentiation, which this guy, literally, you could drop a quarter in the jukebox and he could talk for hours about how he's different, how he's bigger, how he's faster, how he's stronger, he's more nimble, he's got the answers. Eric, we believe in this guy, right? That's why we're talking to him. So he is here telling us we're bigger, we're faster, we're stronger, we're more nimble, we're going to build $1 billion brand. We're bought into this. He's better than all the competition. He is not in a commoditized business, yet he wants to be 25% below market because his attorney said so. So, look, at the end of the day, we don't make decisions. We're advisors. We're strategic advisors. Like, that's our core pillar of what we do. And so we just provide strategic advice, and we want to provide information around of what's market and what the landscape is. And so that's that. Now, in addition to that, what I would say is I think that sometimes there's confusion as to what a franchise fee actually represents.
Yes, that's a good
point. What does it represent?
Well, it's kind of two different things. I mean,
I remember.
It's that the franchisor has the person paying the fee and collecting the fee kind of have opposing views on what that franchise fee is really for. We've never really talked about this.
You want to hear something really, really embarrassing?
Yeah.
This is true. This is a true story.
As long as it's not me.
So
if it's embarrassing, if it's going to embarrass me, then absolutely not.
No.
But if it's embarrassing you, or especially a friend of mine, let it rip. Let it rip.
This is on me.
Good.
So literally I don't know so back in the tax days when I was an area representative, one of the very first candidates that ended up becoming a franchisee. Okay. I mean, I am green. And we're talking about what is the franchise fee for, right? What's the franchise fee for? These guys were in Fort Myers. I'll never forget, man. These guys were in Fort Myers. There was a group of like 4 of them. They wanted to do, I think, half a dozen locations. And it got to the point, we're getting towards the end of the process. We're going through the franchise agreement. They're asking questions about this or that. They're asking for some changes, right? They're asking for an addendum. And this topic comes up around the franchise fee piece, and they're like, what do we get for this franchise fee? They're like, do we get like some computers? Like, do we get something above and beyond? Like, what do we get? And like, what my response was? I'm like, you get computers.
I'm guessing
I said yes.
The green.
I didn't know. I said yes. You get computers. I swear to God. I swear this is like circa 2005 or 4. I'm like, yeah. I'm like, you get computers. Dude, I had to come out of pocket for computers for these guys.
No way. This is the first time I've heard this story.
This is, I mean, literally, I swear on my pinky toes. This is true. I had no clue, but I was like, yeah, you get computers with it. So that is an absolute true story.
Oh my gosh.
And, we're talking about 20 years ago.
What about floppy disks? Did they get floppy disk or were they floppy disks?
I think that was after the floppy disk stage. But I mean, computers were big,
Oh yeah, I know. There's no flat screens way back then.
They were big and they were expensive, and I had to buy them. Because I'm like, yeah, you get computers. Oh my goodness.
Then you found the smallest piece of real estate. Put this into it. Ace check cashing, one computer.
Right. So, I mean, what is a franchise fee? So, I mean, a franchise is a license. It's a license. It's a license that you can wear proudly, and you can wear it internally and on your clothes, and you can actually use a sign. You have access to the IP. It's what you get. Right? You get access to the goodwill of the brand. And you can use that signage, and you can say that you are in the family. That's what it is.
Not real signage. You can use a signage. That signage isn't paid for.
No, you don't get the sign. Just like I shouldn't have given computers, right? But it's access. The franchise fee is access to the IP. It is access to be in the family. It's access to the brand. And so, what I think is market today is most of the concepts that we see are coming to market, and the franchise fee is $60,000. I think that, from what I've heard and, what we're definitely talking to brands about is we believe that that's going to go to 70,000 next year. And so it sounds like a lot of money, right? It sounds like a lot of money, but if you get access to the IP, is it really a lot of money? Because most franchise agreements that we see today with brands are 10 years, right? It's 10 years. And so now all of a sudden it's like, okay, if I pay an initial franchise fee of $70,000 for a 10-year agreement, then that gives me access to the IP for $7,000 a year. That's, by the way, that's exactly how it's calculated in accounting today, right? That was a big shift a few years ago. Whatever a franchisor takes as a franchise fee or charges for a franchise fee, from an accounting, and I'm not an accountant, right? We're not accountants and lawyers on here, but from an accounting standpoint, you only get credit on a pro rata basis for each year that they're still in the system. So if it is 70,000 and it is 10 years, the way that accounting looks at it is you only get credit for $7,000 a year, and the remaining portion is a liability. It's a liability, right? It goes on your balance sheet as a liability. So if your franchise fee is 70,000, in the first year, you get credit for 7,000, and 63,000 of that is a liability, right? Now it's still your cash, right? Whatever the accounting world calls it is one thing. The reality is it is cash. And but certainly from a franchisee's perspective, it's like, okay, if the franchise fee is 70 grand and it is a 10-year agreement, would I pay $7,000 a year to have access to this IP, right? Like any brand that's out there, you have a choice to, if you really like the category, you could go with this franchise. You don't even have to go with the franchise. You could just do it yourself. Is it worth paying $7,000 to somebody to have access to their brand, to their IP, versus me going and creating my own brand and my own IP? I mean, if the answer to that is no, then who are we talking to here? The answer is yes, of course. If you think it's a proven brand and it has strong unit economics and it has strong IP, who wouldn't pay $7,000 a year for 10 years to have access to that IP? So the next question becomes like, all right, well, the other thing too from a franchisor is that it's the cost of acquiring a great candidate for 10 years, right? So it's getting back to some of these other conversations where people say, hey, I need to sell franchises for capital, right? That makes us squirm a little bit, because the reality is that what you want to be able to tell that candidate is like, we're gonna use that capital to reinvest into the business, to build infrastructure, not just to keep the lights on today, but we're gonna reinvest this so that we can improve the system, right? This isn't so that I can take this money and go make a car payment. This is so that I can reinvest in infrastructure, people, technology, processes, systems, vendors, agencies, advisors, whatever it is. And it's the cost of acquiring. There's also an expense to even finding that candidate, whether they came through a consultant or they came through PR, they came through whatever. So one thing that we always talk to franchisors about is look, at the end of the day, I think that your franchise fee should be market. And if you believe it's less, then once again, is it a commodity? No, right? Do you have real points of differentiation versus your competitors? Of course we do. Then why would you be 25% less than? If you have what you say you have, then I don't believe you're going to lose a great candidate because your franchise fee is $70,000 or $40,000. I really don't. Now, I am also not a proponent of saying let's charge fees just so we can charge higher fees. No, I am once again to reiterate and be very clear. I believe that you should be on market, right? And if you are telling us that your offering is considerably better than what everything else is on the market, then you should be more, not less. That just seems somewhat logical. And then, but it doesn't just mean the franchise fee, right? Sometimes we talk, at the end of the day, franchisees, they want to be profitable. They want to get to break even as quickly as possible. They want to be open as quick as possible. people. They want to build a legacy. They want to expand. They want to grow, right? They want all those things. So there's a lot that they can personally do to increase the probability of their own success. But they join a franchise system because they want rock star support, right? They want a rock star system. They want to be surrounded by rock star talent from the franchisor level. They want to have rock star IP. They want to have a rock star blueprint. They want all that stuff. And the franchisor has to deliver upon that promise. That's where you find unity. That's where you find alignment, right? Is when the franchisee says, I want a 10 out of 10 in these 5 things, then great, the franchisor should deliver that. So I do believe that there are, when you do take a look at like initial fees, then there should be some other fee structure pieces above and beyond just the franchise fee. Because if it is going back into supporting the franchisee to get to break even faster, to get to scale faster, to penetrate the market faster, then it makes sense. It's an investment. It's not a fee. It's an investment into the franchisor so that they can make investments into providing you a level of support that is far beyond what anybody else does in the category. So that's my 2 cents on what a franchise fee is.
That's good. And I think that's helpful. It should be helpful to everybody. A buyer should look at that and understand, take that and ask some educated questions to your franchisor that you're looking at, that partnering with, that you're looking at buying into. Listen to this, listen to that again, and do it from the lens of, now I've got better questions to ask my franchisor, because this should be their mindset. If you're an emerging brand, you should be thinking, why do I have a lower fee? And if the answer is because I don't want my franchisees to pay as much so they can invest it into marketing or some of these different things. That's a common thing that we hear as well. Well, why don't you take that money and invest it into infrastructure so they can get an ROI on it versus, so that's one way to look at it. So I think brands right now, if you have a low fee and that is, that's what you want, listen to this again. And even if you want to have a conversation with Jeff and I around this, we're open to having conversations with you. And again, we advise. We're not telling our portfolio brands what to do. We're like, this is market and this is why. And this conversation that we just had around franchise fees are conversations that we have with brands that, might become portfolio brands at some point, or just brands that we're looking into, industries that we like. Jeff, I think we're at the top of the hour. You and I have a call. One of the things that I wanted to get into that we didn't is, maybe we'll do it at a later point, but what happens if you have a prospective franchisee that wants to pick you up in their private jet, fly you around and go look at some locations? Is that a good thing or a bad thing? Real conversation that we have with a brand recently, and the answer might be kind of surprising. So
that's the old tail wagging the dog.
All right,
that's the easiest way for the prisoners to begin running the prison.
Oh man, I've got stories around this too. Hedge fund manager comes in and buys and gets a special deal that did not end well. So, but doesn't mean it's a bad thing. You just have to know what you're getting into. And a lot of people see money, and they see that as an answer, and it's not. All right.
That's true. All right, man. Good stuff. Thank you.
Thank you. Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.